Walk me through this, what the process looks like, the whole acquisition process, from conception to completion, how long it takes, and then we can turn into the investor side perspective, what it looks like for an investor.
Yeah, so I think if we're just kind of simplify it, the the development part of the risk that people think of when they think of development, I think is in the entitlement phase. And
Mhm.
and basically, if I was just kind of break it down for the listeners, it would be we would take we would take an option on the land. So let's just say we
Mhm.
found 30 acres in
Mhm.
Lafayette, Louisiana, and we'll basically option the land. Maybe it's 50 grand or something like that. And we'll take, 9 months to go through all the city approvals. So we want to get in those rooms with the mayors and the council people and the neighborhood council and all the people that kind of make the decision. So there's kind of this
Mhm.
political period before you even buy the land, right? And then once you've kind of got the approvals and the hearings, that's when we would close on the land. And we usually close that with our money.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have a very special guest, my very good friend, Andy McMillan, with me. We've been through hopes to get him on the podcast. We know each other for a while. We've been trying to get on the podcast or get this fireside chat with him for a long time. So finally, I got him here today. So welcome to the Real Estate Wife Show, Andy.
Oh, that's great. It's so great to be with you as always, Vinky. So thank you for having me on.
Of course, I'm super excited to have you with me today, because I'm looking forward to our conversation. So a little bit about Andy. Andy's a fund manager at Legacy Acquisitions. He's focused on partnering with top operators and providing exceptional service to investors. With over 20 years of experience and 750 million in real estate transactions, Andy brings a wealth of expertise. He lives in San Diego with his wife and three kids. And today we're going to be talking about Andy's passion about building wealth through horizontal multifamily. So that's a fancy name for BTR, built to rent community. So the way I understand is, Andy, so correct me if I'm wrong, BTR or horizontal multifamily communities are typically single family homes or townhomes specifically designed and constructed for rental purposes, providing tenants with a suburban home-like experience. I hope I
Yeah, that's better
right.
than I could say it, Vinky. Yeah, we need to bring you on. I think that in general, people think of single family as kind of the scattered sites, and now more and more we're seeing development projects specifically to rent. And so a lot of users, we still own our multifamily. We still love multifamily. I know many of the listeners are focused on multifamily, but we think of it as just kind of pulled apart multifamily. So we'll build about 100 to 300 homes in a community, just spread them apart. And they'll have their own backyards and barbecues and then walking trails and amenities. And we will rent them in the same way that we would rent our apartment projects. They're just newer construction now, and people are on top of under or underneath each other. So this is becoming more and more of a trend, as you know, and you and I have known each other since before COVID even, that it's starting to become um, a lot more appealing for people that are could buy maybe, but the mortgages are so much more expensive now than rents, and they can be in new stuff, for $1,000 less than they would be paying on our mortgage. And in many of the markets that we choose in the South, a lot of the municipalities want us to build and construct there. And in many of those areas, there's a lot of growth. So that's kind of why we feel like that's the trend, the phase that we're really focusing on. We've been doing that for the last 6 years or so.
I know it has gained a lot of popularity too in the recent years since COVID. So tell us a little bit about that too. Why is that? Why it has gained so much popularity? I think due to COVID too, because people wanted to stay in the bigger places, not just kind of cooped up in a little apartment kind of setting.
Yeah, we there's a couple surprises to me. I should probably, if I was smarter, I would have known them. But I think in general, we kind of expected that there'd be a lot of the younger families in their kind of formation years, and we kind of saw that millennials were less inclined, like we were growing up to have the picket fence, and that was kind of the, wealth indicator. Now you can buy your businesses on your phones and et cetera. The idea that having a home and owning it is maybe not as appealing. Maybe you want to have the new tech at the property. So what we started to see was a lot of the younger families in the formation years we thought would be our resident. As it turns out, we've brought in a lot more empty nesters that in past years would either stay in their home a little bit longer, maybe go to senior living, maybe go to apartments in the transition phase. But because there's so much active longer and that the senior living is kind of delayed and the assisted living is delayed, they love the idea of having their own backyard and amenities and walking trails while we cut the grass. So that's kind of been the triangles that you've got the low supply, right? The rents that are pretty healthy. And then what we didn't predict was interest rates being so much higher. So the pool of buyer is so much larger now.
Interesting. So it has created a separate niche for you kind of in the middle, right? Because market always shifts, there's always new trends. I know I'm part of one BTR too, so I'm not sure exactly that if we are hitting the similar demographics like you guys are doing, which is good to know. But you are in like multiple places, right? If I recall, you are majorly in Tennessee, right?
Yeah, so right now we're focused on the South. We love the Southeast, I should say. So Lafayette, Louisiana is a market that we really like because there's so much growth, economic growth and population growth.
Mm-hmm.
Foley, which is like Baldwin County, Alabama, has become a really
Mm-hmm.
popular area for the build to rent because again, in the Southeast, we can buy the land that's relatively inexpensive. We have the
Mm-hmm.
municipalities that want us there, so we can
Mm-hmm.
build so much faster than we could. I'm
Mm-hmm.
in San Diego, as you know, in California, or even
Mm-hmm.
Texas, in a lot of those markets where it just takes longer to build. So the cost of the land is less expensive,
Mm-hmm.
the labor is a little bit less expensive, and the speed with which we can build is a little bit faster. So that's
Mm-hmm.
kind of why we like those areas. Now we still own, as you know, properties in Texas, we still Carolinas, Kentucky, as you mentioned, Tennessee, but
Mm-hmm.
the built to rent focus for us in those areas in the Southeast have been the strongest.
Nice. That's good to know. So let's talk about the difference between the horizontal multifamily and the traditional multifamily. So you have done both, right?
Hmm.
From your experience, I'm not going to say which is better, but which is like more appealing to people in today's
Yeah.
population, basically.
Yeah, I think my view is still that multifamily is strong, and we could
Mhm.
probably talk just in, general macro, terms now where we've got, the interest rates coming down a little bit. We got supply, and there has been less and less construction even over the last couple years that now is starting to ramp up. So I think multifamily is very healthy. And I think because institutional capital is flowing into multifamily, you've got 55% of the owners of multifamily, as you know, are institutions. But for
Mhm.
the built to rent space in the section areas that we're focusing in on, they only own about 5 to 6% of that built to rent market. So there's a lot of upside. We're kind of in the early innings. And what we're starting to see is a lot of the municipalities love to have, if there's going to be new construction, that it be the kind of single family as
Mhm.
opposed to the multifamily, because you get a little bit more amenitized, a little better looking kind of spread out, density. And you also have kind of this, you can move people in as soon as they're built, as opposed to multifamily,
Mm-hmm.
where you're waiting for that certificate of occupancy at the
Yeah.
very end
Mm-hmm.
of the development cycle. So they're
Mm-hmm.
just a different model. I think both
Mm-hmm.
of them make sense today in today's market, and many could argue for the last 20 years. You know,
Mm-hmm.
it's interesting, Vinky, I was listening to, the idea that Goldman Sachs had been kind of, even Chase had been predicting this kind of recession since 2015, right? And so for all this time, there's been a little bit of this kind of insecurity, but because the supply has been so low, there's still a lot of opportunity for folks to be building stuff and owning stuff in the multifamily space.
That's true. And then you said very good thing. You said supply is low. We all know that, right? There's a housing shortage basically overall. And I think that could be the reason that people are just leaning towards BTR or this horizontal multifamily, or maybe it's just gaining more popularity because it gives them like more space, backyard, and they don't have to take care of most of the stuff has been taken care of them because I think there is HOA, right?
In some cases, yeah.
In
So
some
in
cases.
some cases, we don't have to have the HOA, right? If we just rent it out, some of them that we build are individually platted, which is another kind of, I would say, feature of built to rent, in the sense that if you do individually plat the units, you could sell 20 at a time if you wanted to. So if we build 150, we could sell 20, 50 at a time if they're individually platted. In some cases, there's PUD, which you just basically a planned urban development, where you might have one single multifamily designation that you're building single family homes in. So in that case, you have to either, if you want to sell them off individually, you need to have an HOA. So I don't know if that answers your question, but
Yeah, no, it does. So you're doing the ground up, right, for this horizontal multifamily.
right.
You're doing the ground up construction. So walk me through this, what the process looks like, the whole acquisition process, from conception to completion, how long it takes, and then we can turn into the investor side perspective, what it looks like for an investor.
Yeah, so I think if we're just kind of simplify it, the the development part of the risk that people think of when they think of development, I think, is in the entitlement phase. And
Mhm.
and basically, if I was just kind of break it down for the listeners, it would be we would take we would take an option on the land.
Mhm.
So let's just say
Mhm.
we found 30 acres in
Mhm.
Lafayette, Louisiana, and we'll basically option the land. Maybe it's 50 grand or something like that. And we'll take, 9 months to go through all the city approvals. So we want to get in those rooms with the mayors and the council people and the neighborhood council and all the people that kind of make the decision. So there's kind of this
Mhm.
political period before you even buy the land, right? And then once you've kind of got the approvals and the hearings, that's when we would close on the land. And we usually close that with our money.
Mhm.
So we've owned the land, we've got most of the entitlements done. We'll finish the engineering with the dollars that we utilize. And then we'll kind of hit what I'd call the second phase, which is the horizontal and then that's
Okay.
kind of the phase where you would be building the streets and the roads and the utilities,
Mhm.
the infrastructure. And then the third phase is the unit build. And that's the kind of least riskiest part, because you're the Bob the Builder at that point, just putting up units. So I think if we can strip away with each phase a little bit of the risk, then it makes a little bit better opportunity for the investors. And we try at each of those phases to price that risk into it. So if you're coming in earlier, your return would be higher. You coming in later, you would have a little bit, quicker time horizon on your investment.
So let's talk about here, what are the key benefits of horizontal multifamily for investors, both from a cash flow and an appreciation standpoint? Because if you're doing development, there's not necessarily much cash flow upfront. So what exactly is the key factor that attracts investors towards this community?
Yeah, well, I think what you bring up is such a good point, because even in the multifamily space, we've seen
Mhm.
this over the last couple of years where you'd have this cash flow in day one, or maybe in 6 months or 9 months or 12 months, and then that even kind of evaporated, and you kind of have to kind of figure out other ways to either raise for, a little bit more, or you have to consider maybe a debt fund in which you're utilizing your track record and balance sheet in order to kind of pay folks that would be lending you money as opposed to investing in the project. So I think things like that have been a little bit of a sea change in the way that
Mhm.
investors, they want that cash flow. They like development, but they don't want the risk. So for us, we've kind of had to play in that middle, which is, well, hey, we've been doing this for 20 years. Our GP team is strong. We've got a heavy balance sheet. We've got the wherewithal to kind of weather some storms. Why not give personal guarantees and maybe even pocket judgments for taking in lender dollars, private lender dollars, give them that 10 to 14% return,
Mhm.
and that way they're getting their monthly payment, and maybe it's either an option to invest in the project later on, or some kind of convertible note. There's different ways to structure it, but in general, that's been kind of the piece where I've seen folks kind of bypass this scary period of no cash flow coming in, is let's invest in teams that are strong enough and collateral that's strong enough that would give me my 12 to 14% a year paid quarterly or monthly. So I think
Mhm.
there's ways to structure deals now on development projects.
So then, like you were saying earlier too, you can go in phases, right? Because then you can bring different investors at the different phase of the project. And depending on that, the return's gonna be aligned according to what time they come into the project.
That's right. So yeah, so an investor that's coming in on the horizontal while we're building streets and roads, maybe a little more risk, so he gets a little
Mhm.
bit higher
Mhm.
return. If he's coming in the last year and we're kind of on the downhill slope, his return is going to be a little bit less, but his risk is much less. It's interesting in listening to kind of all of the economic news that comes out now with our inverted yield curve and cap rates depreciate, all of the kind of things that we hear about in the multifamily. I'd be curious to hear your take on it. But one thing that does seem to be, I wouldn't say impervious, but the real estate market is less exposed because there's so little supply. And so as interest rates do come down, which I believe that they will, but even if they stay a little bit higher than normal, you still have the need for housing. Now, I would, there was a caveat there. I do remember in the 2008 cycle, you can kind of see part of it on my face, that people started to kind of move back in with either
Mhm.
their parents, or they started to kind of double up, right? So
Mhm.
it's not a true statement to say that because there's little supply, more and more people are going to need housing, etc. But because real estate is localized, you can even see in many of the markets that supply is low, the rents are increasing, the job growth is there. And in those markets, even as we kind of see their macro part descending, there's areas that are still ascending in local markets. And I think that's important for people that are considering or maybe on the fence about alternative investments in general, is that there's always opportunities in a part of the country or an asset class as it pertains to real estate. And usually multifamily, despite people that say that we're, heading for a recession on the multifamily space, usually those things are softer landings because of the supply issue.
That's true. And plus, it's not applicable to everything. I remember that I'm going to use that analogy over here when I was teaching and also when I was working for the Cooper World too. So I always used to use this example, like people say, I have a banking background. Sometimes people say, oh, system is down. System is down. That does not mean the whole bank shut down, right? All the accounts are frozen or anything like that. it could be like a one small little problem. So you have to break down a little bit, like kind of simplify things. So news is, yes, it's good news, bad news. Most of the time it's bad news. But it's not applicable across the board. There are still pockets out there. There are still good deals. There are still good operators. And then a real estate you cannot really go wrong with, because this is something you're buying, something tangible that you're investing in. And it's a long-term game. It's not an overnight get rich scheme. That's the other gimmick that people have, that I put my money in today and tomorrow I'm gonna be millionaire, multimillionaire. It does not happen. It's a slow and steady game. So you're in it to win it as long as you understand that and you're adapting to the right strategies. But being said that, I wanted to ask you this question. I'm really curious, how did you get started? And especially in the horizontal multifamily. Oh my God, I love this fancy name.
I know the pulled apart multifamily, horizontal
I know.
multifamily. It's so fascinating. Like I had a college friend who he started to work for this company called American Homes. And it is interesting, like even in 2008, I'll try to keep my answers brief because I know for podcasts, I have to stop wanting to talk, even though that Vinky and I go way back and we just want to emote to each other about our lives. But I do remember that in 2008, the music did stop. Like there was no lending. So you had to find other opportunities, right? That's kind of in this where we are in this market, real estate is still localized. It isn't that situation where you had in 2008 was kind of this global recession where lending now. So there was these smart dudes that partly responsible for the GFC that decided, hey, why don't we start buying all of these homes in scattered sites like American Homes for Rent? And I was like, man, they're buying these like on 50%, 50 cents on the dollar. And I thought, man, that seems interesting that those are the same folks that probably were responsible for some of these higher this recession, that they're buying these scattered sites, maybe now 50%. But they were so spread apart that there was all these inefficiencies. So I had met somebody, to answer your question, that had kind of figured out in the Louisiana, Alabama, Southeast market, maybe I could build 20, 30 at a time next to each other. And then as far as instead of trying to have one manager that's got 50, 10 different counties, we've got this kind of economies of scale. And that's kind of when the light went on that, hey, maybe there's the opportunity here. I started talking to my friend he works on a much bigger level. American Homes for Rent was, kind of in that Blackstone private equity group. And it just became apparent that because the efficiencies are there, you can build with expenses that are maybe in the 32% range, as opposed to a multifamily 70s, 80s, 90s build where you got 50% expenses and you've got residents that want to stay longer, that are stickier, right? Because if you're taking care of them and they've got their walking trails and backyards and they can see their neighbors walking down the street, as opposed to yelling at them to keep quiet upstairs above, it just kind of makes intuitive sense. So there is a macro piece of why it all makes sense. But if you kind of just think about, Vinky, that neighbor that you had that was a renter, that maybe their grass was a little bit longer than the rest of the ownership in your neighborhood, that stigma no longer exists. Now it's kind of like, hey, I could be in this community with all these other like-minded people with new stuff and walking trails, and there's no stigma attached. So that's part of the reason that the light turned on in 2000. That was probably about 2017, 18, and we were still doing some multifamily stuff. So anyways, that's kind of the short of it.
So I just feel like you're so passionate about it. I can hear you in your voice and your
Yeah.
gestures, like you are just building more than just the homes or the rental homes. You're just building the communities,
Yeah.
and I can hear in your voice all the enthusiasm and your passion, which is pretty awesome. So I'm going to ask you this question, you've been talking about Louisiana in Alabama where you're building, or Tennessee, multiple places you've been building. So what are some of the important factors to consider when you're looking for a certain location, like where to build, which is going to be stickier place, where you're going to find
Yeah.
right tenants for your community?
Yes, so a lot of it is created. So you mentioned the kind of passion of my voice. I'm older now. I'm kind of in that what they call halftime, that second half. And to me, I've kind of figured out, as you have, Vinky, that it's more about the people, right? That's what we can kind of take with us as the people. And so the community part of it, it's selfish. I completely admit it. I have no like don't give me that altruistic,
Mhm.
name. I don't want it. I'm just saying it makes me feel good and like I've accomplished something when I see that we just had dirt and now it has actual families that
Mhm.
are thriving in a community, right? That does give you a certain juice that you can't get in other places. So, in communities like the Southeast, if we can bring in people that are building out those communities, that are putting together events, we've got an event in December coming up at one of our projects. We'll go out there and we'll turn it into this winter kind of Christmas vibe, and we'll have the jumpy parks and our playgrounds and a lot of the community kind of walking around. And to me, that's kind of selfishly what I get out of it. But those people now know their neighbors in a way that this is their home. And so those markets, when you can kind of buy stuff, that land that's next to good schools, that's next to kind of family formation years, that's next to a demographic that does have, empty nesters that want to be in these communities, then we can really focus in on what are those pieces of the puzzle that we can add that will allow them to thrive. And that might be anything from community barbecues to Bible studies to financial planning classes. Like that's the stuff in this world of apartment investing and built to rent investing that we've got so much more power than we think, for families that choose to come home as their home, not to their, just short-term 6 month, solution to their problem.
Great. So let me ask you this question. This came to my mind when you're talking about all these, things that you're doing for the people or the communities that you're building. So I'm not sure if you're doing this already, all this sustainability or the energy efficient projects in your community, but what role does the sustainability or energy efficiency play in the horizontal multifamily projects if you're using it? And how
Yeah.
can this impact the investor returns? Because today, everybody's talking about this ESG, the sustainability, going green and all that. People are really, really passionate about it to save the planet. So what is your take on that?
Yeah, so my take on whenever this is just me. I care more about the people. If I'm just going to put a hierarchy, the people and the planet, the people, sometimes there's a Venn diagram when they come together, right? Because you're trying to do
Mhm.
these things that
Mhm.
benefit generations and generations. So it's all part of it. And what happens oftentimes is you'll get investors that maybe don't believe in some of those things, or they believe in those things, but not with my money, right? And
Mhm.
what I have to constantly remind investors is that there is a way to do good and really good
Make money.
returns, something
Mhm.
for our investors, right? That makes it much better for them. It's better for them if they've got a resident that stays longer, that wants to be there. It's better for them if the playground and the community events bring in higher rents. It's better for them if there's people that are saying, gosh, isn't it great to be in a legacy project where they care about this thing or that thing? Isn't it great that we're in, where there's actual green around and there's efficiencies and solar and those. So these, I try to remind people that it is only in service of the people, the investor and the people that we've got in our communities. Rarely, in some cases they do, but rarely do those two things contradict each other. And that's what I try to remind, I've heard, I've had investors, be completely frank, where they say, hey, you would do whatever you want to do with your money, your charity, that's fine, but it shouldn't come out of my returns. And my retort for that is your return. Your return is at the bottom of this pyramid, is all the stuff that goes into the community. So yeah, that's the kind of short of it. And that
That's
isn't
good.
easy, right? ESG is not always easy because sometimes the economics don't align. You have
That's so
to be
true.
able to sell the fact that there's some things that are anecdotal and not formulaic that bring you better returns. They might not show up. It's like I talk about athletes that have stuff on the stat sheet that maybe doesn't show up. They play defense, they screen well, they box out, the
Mhm.
hockey assist, all of those things sometimes don't show up for investors to see.
Yeah, by the end of the day, I think it's all about experience that you're trying to create for your community and for the investors, as they're getting the experience, whatever they're and you're catering to that, I think you're in a good place. So let's shift the gear over here. I wanted to touch a little bit on the risk and challenges involved with this horizontal multifamily. So share with me some of the unique challenges or risk associated with the horizontal multifamily development that investors should be aware of. From your experience, what challenges you went through, if you can share that, that's going to be pretty awesome.
Yeah, absolutely. I think that you've probably heard many times on your podcast, insurance costs going up. That's
Mhm.
obviously a pain. Um, I think that the thing that people have to consider when anything in real estate that's related to speed with which you can actually achieve these things, that
Mhm.
is where the money for investors are made in development. So anything that is impeding your progress, um, is sucking out of returns. And so we have kind of a chart we look at that's, hey, here's how much we're paying in pref, and here's how much our daily rate. So any of these delays, I have to think of those people that, I've got college roommates and friends from organizations that invest with us. I'm thinking about all of those delays. So those are things sometimes that are very difficult to navigate, and they take a team of tenacity, a team of tenacious people that if the morning is raining, in the afternoon the subs are out there with whatever they need in order to build, and they're paid for that, right? Whether it's overtime or
Mhm.
inducements, whatever that is. So those are the things. So the macro part of it is like kind of the perspective, oh, insurance has gone up, and interest rates are higher, and you know um Silicon Valley Bank has all these regulations, so now there's less money for development. Those things are to a certain degree out of my control. Now we can choose projects in an asset class or a market that makes sense, but the efficiencies and the operation of how quickly we can move things and how quickly we can take care of the people that are occupying our communities, those are the things that are constant. And in this business, Vinky, that I could explain to you some of those things, but that tomorrow will be something different, which is why the
Exactly.
people that
Exactly.
are managing that process are so important.
That's true. And as long as you're communicating with the investors, everything, whatever is happening, either there's a delay or no delay or something is a shortage, oversupply, whatever, as long as the communication is constant with the investors, it is okay. Because everybody understands that, when you're trying to start something from the conception, it takes effort to take it to the finish line, which is you're doing pretty awesome job. So let me ask you one question, now the last question, even though I'm going to keep on talking, you have tons of information that you're sharing. So in your crystal ball, what do you see in the next 5 to 10 years, how this build to rent community is going to evolve? And also, what trends or innovations do you see emerging in this horizontal multifamily space?
Yeah, it's a great question because so much of this is changing daily. We've looked at modular because of the timing issue that I just described, the process of construction, and especially in markets where there may be some weather that you're accounting for. If modular becomes much more favorable as far as pricing in many of these markets, that's a game changer, right? If you could have almost all of your construction done,
Um,
dropped in on a crane. Imagine the the predictability that you would have in this space, right? On the earlier phases, entitlement
Mhm.
phase. And the other is, as I mentioned, we're still in the early innings of big money coming here. So if you've got, a lot of money that starts to flow through that sees these kinds of returns and the margins being stronger, that's going to be a changer. And a lot of the tech that makes these places maybe even more appealing than buying homes, right? Because if you're paying, 1,000 less, but you've got, the the tech that allows you to turn on your air conditioning on your way home or your heat on your way home, which we have in some of our project, all those things are kind of stacked on top of each other. And now it forces you to think, well, I'll make that connection. Well, then that means that I can get the modular and the tech, and I can build faster, and I've got these supply crunches. So there's a lot of, in the next 5 years, I could see, maybe we're in that fifth or sixth inning, but a lot more of this kind of pulled apart multifamily. And I don't think that necessarily even detracts from multifamily. I think that it basically there may be kind of choices, like economics is always about choices, that maybe
That's
it's
true.
easier to build single family as opposed to the multifamily, but that makes the multifamily projects much scarcer, right? But in that same fashion, you're seeing, ways to build multifamily constructions faster, rehabs faster, tools are faster, tech's faster, marketing's faster. All of that is really, really a game changer. I'm sure there's hundreds of things I left out, but I'm curious what your thoughts are on, like, where you see the next 5 years. I'm sure you've thought about that question as well.
That's true. Everybody says it's all just a speculation, things are changing. I just feel like it's gonna be super smart homes, you know, and 5 years from now, it's gonna be totally different world.
Yeah.
With this AI, blockchain, digital currency, so many things are happening. It took us 100 years to get here, but it's just a matter of time now. Snap of a finger, we're gonna be totally into a new world. Like just we went through the black hole, boom, whole new world. But the only thing is, whatever is not in our experience, it's very hard to peek in. So it's very hard to peek into the future. So whatever you hear people talking, just speculations. I think this, I think that. The ideas are different because whatever somebody's experiences, that's what they're predicting.
Yeah,
So,
right.
if you understand what I'm trying to say. So,
Absolutely. I mean, I,
yeah,
I think about, I live in San Diego, you live in Northern California. We have a view of the way things take much more time than they should, right? We
exactly.
also
Exactly.
have we also have this kind of built-in resilience that nothing is going to work out the way that we wanted, and you better be ready for plan B, C, D. It almost doesn't matter what that plan A, you're going to have to iterate because you've decided that you wanted to do business in California, right? And that's just
Yes.
the real estate game in general. I think often about how I had a lot of luck in 2008 that it could have basically crushed me. I had happened to have Google kind of, and the development we were building in Venice
Mhm.
Beach at the time happened to be Google bought headquarters right next to it. So they were able to occupy a lot of the spaces that we were kind of retrading. We were retraded by the rest of the market. So I know that there's things that can crush folks, but just know, as Vinki said, that if you're kind of thinking about it, not from your worldview, but from a mental model
Yes.
of how it would look and then work backwards in incremental stages, then it becomes easy to see, of course, modular works. Of course, prop tech works. Of course, markets in the Midwest where maybe you don't have that same appreciation, but you have these margins that make more sense. So, and then, obviously we haven't even got into the benefits of real estate with just, tax and cost
Yeah,
segregation.
exactly. I need to have you back because we are out of time. We are way over time. I
Uh,
need to have you back because there's a lot more to talk about that. I knew that when I'm going to have you on the podcast, we're going to run into this issue. But anyways, share one golden nugget with my audience.
Um, okay. I'm gonna just this is kind of actually current. So this I don't know this is going to be evergreen, but I do think it could be depending on how you look at it. The part of this economy that we're in right now is scaring a lot of folks, and part of that is because we're hearing about our debt. I think that one thing to consider about all of that is that the debt that we currently hold is mostly American citizens and interdepartmental debt, right? Now, some of that is foreign, which is probably good, right? If we ever go to
Mm-hmm.
war with China, we want to make sure we've got some of that debt, right? That we could pay them back if we need to, or withhold paying them back. But I
Mm-hmm.
think that in general, people start to think about all of these things that could go wrong, and real estate is local. In every market, there is an opportunity. There's a new business that's coming. There's a new job that's coming. And I think that all of those things will lead somebody to think, I could just think about it a little bit different. Still real estate, just a little bit differently. And the fear is what usually, somebody listening like now is like, I just lost $50,000. I just lost $100,000. That might be true, but I guarantee if I did that when I lost, and I have, like we all have, that we would have never been able to kind of figure something out with built to rent or multifamily, or not even me, the investors that were able to kind of help. So I just think that there's different ways to look
Yeah,
at it.
I like that. That's a good advice. If something like that happened, bounce back faster, bounce back maybe with the twice the force or maybe 10 times the force. So you can just go way up higher. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer it only in one word or
Oh,
one
I
sentence.
can't do that.
Are you ready?
Let's try it.
It's
Like, it's
it's
gonna
a
be
really good test.
I
Okay.
think I feel like I know that you've been doing this for a while, but I feel like you made this one for me because you knew I couldn't do it. So let's try it.
Let's give it a shot. Well, first question. What is one of the most important thing that you've learned in your life? And how did your life change after learning it?
This is one word, right? Yeah.
One word or one sentence.
Inertia.
Okay.
How did I break through inertia?
Yeah. So tell us the how to break through the inertia. Eat less.
What's that? Eat
I say
less.
eat less.
I just think that it's reps, and it sucks because I'm older. I've got all this experience on you guys. You're younger. You go to the gym, and you look great. But it does take discipline to work that muscle that helps you break through inertia, and that's
And
the only
stay
way to do it
active.
is reps. Yeah.
Mhm. That's good. So share one good book that you like and like to recommend to my audience.
Yeah, it's relevant to what we're talking about now is innovators. If anybody's read that by Isaacson, Walter Isaacson, that's great. Also, A Hard Thing About Hard Things, Ben
Mhm.
Horowitz, the best book I ever read about a business like mine that was broken at one point in time. Maybe you can have me back on that, and how we fixed it. Most books are written about not to break your business. This one was written, oh, you broke your business. Let's fix it.
Fix it. Oh, that's a good one then. In one word, what does life mean to you?
Faith.
Oh, I like that. What is your biggest passion?
Family.
I like
Uh,
that.
that is my biggest passion, as tried as it sounds. Sorry.
Just spend time with your little girls, right?
Well, no, it's not
Mhm.
just yeah. I think of it as friends and family in
Nice.
the same way it's people, but that
Mhm.
that people sounds like ridiculous. But
No, this is good. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
uh, no one cares. Get over yourself. Don't be afraid to suck at something.
I love that. Oh my God. That's the best answer. Thank you so much, Andy. So how can people reach out to you?
Please reach out to me. I'm on LinkedIn. Legacy Acquisitions is our website. I would love to help anybody that's interested in this game. As you know, we both think he had a lot of mentors, and a lot of help, and people can't advance without them. So we're happy to be that resource for folks.
Thank you so much, Andy. I really enjoyed our conversation today. So I'd
Thank
love to
you.
have you back one of these days again to pick up where we left off.
Thank you so much, Vinky. I can't wait.
Thanks.